In Money Matters, the JSE All Share Index was slightly up this morning, its highest in over a week, mainly driven by heavyweight tech, Naspers and Prosus, industrials and financials. Meanwhile, global investors keep a cautious stance ahead of the U.S. inflation release for May, due next week, and the outcomes of the Fed's two-day rate decision meeting starting on Tuesday. We're now joined by Sanlam Investment analyst Roy Mutooni to help us make sense of the latest market moves. A happy Friday to you, Roy. Is that reflected on the markets at midday trade?
Happy Friday. Well, not quite, but like you said, the markets are marginally up. And I think what you're seeing here is just a continuation of the trend that we saw beginning this week of local stocks, local SA Inc. domestic stocks outperforming the big rand hedges. So what you're seeing is like the banks outperforming at the top of the log, and at the bottom the commodities and some of the rand hedges. So it's basically a story that's been sustained, so marginally positive as at 12 o'clock.
Okay, oil prices look set to post their second straight weekly loss as prices continue to fall on Friday over demand concerns and skepticism that the US and Iran could strike a nuclear deal.
So this is an interesting one. It's very much a tug of war between what we can see being slowing global growth, so a very slow recovery in China and global growth elsewhere not recovering as well, which means that demand for oil should remain muted, and an increased supply from places like Russia. And now the risk that if the US and Iran can come to an agreement, then Iran would increase its production. At the same time, you're seeing the Saudis taking out about 1 million barrels per day to try and support prices. But it looks very much like a losing battle. So at this point in time, the tug of war is probably being won by those who believe that demand remains soft and global growth concerns become more and more important. So maybe for us here, we might be fortunate that as the rand is strengthening, we see softer oil prices, and that translates into softer inflation, which might help us from an interest rate perspective.
With the way we have electricity now and those news, let it continue. So Foschini Group has published its financial statements for the year ending 31 March 2023. Help us make sense of the numbers and what drove the performance.
So they saw strong growth in revenue numbers. They also had very improved gross margins, but all of this was taken away when headline earnings fell, and this was largely because of load shedding, so reduced footfall in their shops. I mean, they even mentioned that they probably lost something like between 400 and 700,000 hours of trading over this period of time, and also impaired credit, which is also a story that we're seeing with the banks. So by and large, I think broadly a bit softer than the market expected, very indicative of a weaker consumer and very reflective of the tough economic environment that we see panning out all around us.